Okay, good afternoon, everyone. This is Michael Kimmel, and I'm happy to welcome the over 200 registrants to RPB's Winter 2022 installment of our quarterly webinar series. I do hope that everyone is healthy and that you are otherwise doing well. Yes, a couple of our staff had come down with COVID somewhat recently, but thankfully both of them have fully recovered. And the rest of us here at the RPB staff and the board continue to be healthy and are doing well. In addition to myself and Len Teitelbaum, chair of the RPB board, joining us today are David Baskin, chairman of Baskin Wealth Management and chair of our investment committee, and Brad Smith, partner with NEPC, RPB's outside investment consultant. Today's agenda, after Len provides some opening remarks, David will then go over what happened in 2021 with the markets and give an update on the RPB plan and our investments. We'll then turn to an interactive roundtable with David and Brad and Len, who is prepared to answer some questions, burning questions I think many of us have about what's happening these days. And then we'll follow by a Q&A session where we'll open the floor, so to speak, for your questions. Now, before I turn it over to Len, who will provide some opening remarks, a few things. First, as always, the webinar is being recorded and will be posted to our website in a few days. We'll also email a link to you. Regarding those questions, thanks to those who submitted them in advance, we will address them at the end of the session, as well as those submitted during the session, which you could do anytime by clicking on the Q&A button found at the bottom of the screen. This can be done anytime, like I said. Now, Len, the floor is all yours.
Thank you. I need a new floor, as a matter of fact. Before I get into some formal remarks, I believe there's something everyone on this panel should know, and every one of our participants. We all know about Michael, who deserves an incredible amount of praise for putting up with me and my views, but also for helping to run the RPB in a most efficient manner. You've seen Alice Gunn, your CFO, at various and sundry cohort meetings. And of course, Maria Rodriguez, who keeps the lights on and makes sure everything works right. And Stephanie Berger, who's really the engineer behind these types of events. She does an extraordinary job. But there's some names behind the scenes that we think you ought to be aware of. They get no publicity. But what we'd like to see is that they give thanks. Robert Perry, you know from answering your questions. Wonderful, wonderful, talented individual. We're lucky to have him. Daniel Rosenblum, Nicole Daniel, Vanessa Stevens, Chase Bucci, Lois Allwood. These names you may see on a website, but please take my word for it. Your RPB operates incredibly efficiently because of who they are and the incredible job that they are doing. So I would like to publicly acknowledge them and thank them, and hope you would as well. And now to some formal remarks. In our previous webinars, the status of the markets were encouraging and fun. Recently, the mood has changed and the market reaction has made a significant detour from its previous direction. Or has it? Our professionals today will review the current state of affairs and try as best they can to provide you with information you need to make more informed decisions. Questions like, is inflation temporary? Are negative factors already built into the market? Will the Fed feel more compelled to raise rates? Is there a basic shift in the fundamentals of the market? And many more that we will cover in the next several minutes. Now, we all realize that our audience spans the spectrum from those whose tenure in office may be measured in months or a very few years, and those of us who may be grandparents. It's tough then to really speak to everybody as a whole. And I want to emphasize that in the future, near future, with Stephanie's help, we'll be having some targeted webinars for those in various age cohorts. Again, our goal here is to try and educate both ends of this spectrum so that you can make decisions based on a better understanding of the environment that we currently live in. It's now my turn to run for the bushes and turn it over to David. David, please.
Thank you very much, Len, and good afternoon, everybody. The last 3 years have been quite rewarding ones for most of our participants, as markets have been relatively buoyant. And this, of course, in spite of the COVID pandemic. Certainly 2 years ago, in February of 2020, when we first learned of COVID and we became aware of the potential to disrupt our lives, none of us would have expected the markets to put in such a strong performance. But in fact, over the course of the COVID pandemic and in the year before that, most of our asset classes performed quite well. In 2021 in particular, those who took more risk gained more reward. This is not always the case in the market. Some years risk is rewarded amply. Some years those who go out a little bit on a limb find that it's being sawed off behind them and they suffer adverse consequences. But in fact, 2021 gave ample rewards to people who invested in equities, and in particular in American equities, and in particular in the technology sector. Those who invested in more conservative sectors, particularly bonds and fixed income instruments in general, found that they did not have such a good year. Our chairman referred briefly to the specter of inflation, which is now probably the primary concern of our regulatory apparatus, the Federal Reserve Board and the Treasury Department. During the latter half of 2021, concerns about inflation certainly infected the bond market, and people who were heavily weighted into fixed income as a result did not have a good year. Could we have the next slide, please? Every year we show you our colorful quilt, which simply shows the returns of different kinds of assets during not only the past year, but in fact also for the 20 years preceding it and for the 10 and 20-year averages. 2021 is the fourth column from the right. And in 2021, the best performing assets of all were real assets, real estate, oil and gas. Those outperformed everything else. And that was in marked contrast, particularly for oil and gas, to its record in the previous 5 years when it had been a lagging asset and real estate had been a mixed performer. You can see the bright orange square, third from the top, the Russell 3000, which is a proxy for the broad stock market. And you can see that a return of 25.7% was earned by people who invested in that. And going all the way down, we get to the second from the bottom, the Barclays US Aggregate Bond Index, a proxy for fixed income investments, which had a negative return of 1.5%. And the very last category, the Morgan Stanley Index of Emerging Market Stocks, which had a negative 2.5% return. Those who invested outside of the developed world had a particularly difficult time, and that may be a reflection of the slow progress being made in vaccinating those in less developed countries. But the point of the quilt, and the reason we show it so often, is to show you the importance of diversification. Every year, we don't know which asset category will be the best performer and which will be the laggards. You can see that over the course of 20 years, Every sector has its time at the top and not infrequently its time at the bottom as well. That's why we emphasize to all of our participants the importance of diversification and the danger of overconcentration in one asset class. Could we have the next slide, please? Thank you. We now have, as you know, 5 main managed products in the RPB lineup. The focused growth fund is the most aggressive. It's, as the name suggests, focused on equities and growth. The least aggressive of the 5 managed products is our focused income fund, which is mostly focused on fixed income products, and 3 intermediate gradations. The moderate growth fund, which only became available for investment partway through 2021, and the moderate income fund, which similarly only became available partway through the year, do not have representative returns because they were not in business for the whole year. They were only there for 5 months of the year. So I'm going to concentrate my remarks on the 3 products which are more familiar to you: the focused growth, the growth in income, and the focused income. And as you can see, and as I said in my preliminary remarks, the more risk, the better return. The green line on the far left of the graph, the focused income fund, showed that product had a return of 19.6% and beat its benchmark of 17.2% by 2.5%. That's a terrific return in any year. The growth and income fund, which is our most popular blend of equities and fixed income, had a return of 11.6%, also beating its benchmark by 2.5%, and a terrific return by most measures. And our focused income fund reflected, as I said, the poor returns available in fixed income in 2021. It did eke out a positive return of 2.8%, and it did beat its index by over 2%. Nonetheless, not a great return. Finally, our capital preservation fund, our most conservative product, which seeks to ensure that no money can be lost under any circumstances, had a very modest return of 1.4%, again reflecting low interest rates. And our Reformed Jewish Values Stock Fund had an excellent return of 20.9%, leading all the rest. Let me say that that is because in our weighting system, technology stocks get overweighted because of their low carbon footprint. And that, in a year in which technology was the great overperformer, led to the wonderful performance of the RJV. So those of us who put our money where our values are got rewarded this year. Could we have the next slide, please? Volatility is a measure of risk. It tells you how much change in the value of your investment you can expect during a year. Lower volatility is less risky and therefore better. Our aim is to get as much return as we can per unit of risk. And as you would expect, as we go from left to right, the riskiness of the products goes down as the amount of equity investment in the product declines. So our focused growth fund, with a standard deviation of 12.6%, is our riskiest product, whereas our focused income fund has a very modest standard deviation, telling you that it's a very low volatile product. A non-risky product had the lowest measure. I think this is a useful slide. Again, because diversification is something that's important to us, the growth and income fund, which sits in the middle of the graph and in the middle of the risk spectrum and in the middle of the reward spectrum, shows the value of diversification, both in terms of return and in terms of the amount of risk that our participants are taking on. Next slide, please. number of years ago, we made available to our participants passive investments in funds which are not managed directly by the RPB, but are managed by Vanguard. These are funds which track various measures. On the far left, the Vanguard Institutional Index tracks the S&P 500, the 500 largest publicly traded companies in the United States. As you can see, investors in the S&P 500 had a terrific year, 28.6%. Next to that, the small cap index, these are smaller companies. And next to that, the developed market index fund. This is developed markets, which include things like Japan, South Korea, Northern Europe. And finally, the Vanguard Emerging Market Stock Index. As I said in my preliminary remarks, emerging markets had a bad year, and investors in emerging market equities did not share in the rewards that we found primarily in North America, but also in the rest of the developed world. Those who invested in real estate funds had a fabulous year. Real estate was the sine qua non, the star performer of 2021. And as I have also mentioned, those who invested in fixed income seeking safety found that in an inflationary atmosphere where we all fear rising interest rates, fixed income did not provide the safety which they wanted, with negative returns on the Vanguard Total Bond Index and on the short-term bond index, and only modest returns on inflation-protected securities, which were certainly the place to be in the fixed income world. Next, please. So that's the outlook, the returns for 2021. I think that most participants will have ended 2021 with their plan at a record high level, the possible exception being those who were heavily invested in fixed income or who had a heavy weighting towards emerging markets. But I think most people went into 2022 in very good shape. And that concludes my review.
Thank you, David. That was very informative. I hope everyone took something away from that. Now we're going to turn to our roundtable discussion, and we have a series of questions, and David and Brad, and as well as Len, will also add to the conversation. And so we'll just jump right into it, and I'm sure this will also prompt some additional questions from you, which I'm monitoring right now in our Q&A, which I promise to get to towards the end. Okay, so for our first question, what is the impact of the ongoing COVID-19 pandemic on the economy and the markets going forward? Brad, you want to take this one?
Yes, thank you, Michael. Good afternoon, everybody. There's no doubt that COVID-19 has been one of the most significant drivers of equity and fixed income performance over the past 2 years. And one of the biggest drivers of that was essentially the impact as a result of the lockdowns. And what we have seen over the past year is that because of the successful vaccine rollout and other good therapeutics that have been out there, that the impact from COVID has begun to diminish. The other big driver that we've seen out there has been just the significant amount of fiscal and monetary stimulus that has been unleashed by global central banks across the globe. And as part of the evidence of that, we've got 2 graphs on the page here. If you look at the graph on the lower left-hand side and look at that dark blue line, what you can see here is just the labor participation rate for people aged 15 to 64. You can see right before the pandemic hit and the lockdowns occurred, the labor participation rate was well above long-term averages. You can see that drop off, but you also see the recovery above the 10-year median return. If you look on the graph on the right, you'll see 2 different reported levels of unemployment. The light blue line is the headline unemployment that I think a lot of people are used to. The dark blue line represents the U6, which is essentially the regular unemployment, the blue line, but it also includes underemployed and people that are discouraged, that may have given up looking for a job, may have gone back to school. So most economists view the U6 as a more revealing measure of a country's unemployment situation. The point here is if you look at that really large spike up as COVID hit and look at where we were at the end of 2021, you can see that the numbers have come down incredibly dramatically. So because of a lot of these statistics, as well as a lot of other data that we'll get to here in a few minutes, it's expected that COVID-19 is going to have a diminishing impact on markets. And we actually believe other things like inflation are going to be bigger drivers of market volatility going forward. And we'll touch on inflation in just a few minutes.
Thanks, Brad. David or Len, anything to add?
I don't want to say that COVID is over because we don't know what's going to happen next. As we sit here today, a number of states are removing mask mandates and attendance restrictions, and in other ways trying to open their economies to where they were prior to early 2020. I hope that that's the right thing to do. Nobody saw the Omicron variant coming. Nobody knows what's coming next. If this is in fact close to the end, then I think we'll see quite a robust return to normal life. But we have to bear two things in mind. Number one, central banks around the world have been extraordinary in making easy money available to fuel the economy during difficult times. And governments around the world have been extraordinarily lavish in terms of spending, which has also buoyed the economy. You can expect both of those to change once we return to normal. So the good news is COVID might go away. The bad news is that easy money and lavish governmental spending to support the economy might go away at the same time.
Thank you, David. Okay, next question, David, will be for you, and then Brad or Len can add to it. What would be the drivers of asset class returns, and what should investors watch out for in 2022?
So we've already seen some interesting indications of that in the first 6 weeks of the year. I would say without question, the biggest thing driving investor expectations and returns in the market has been fear of inflation, and that the Federal Reserve Bank in the United States and central bankers elsewhere will be too aggressive in raising rates and will not only choke off the economy, but in fact could give rise to a recession. I'm going to talk a little bit about history just for a minute and go back to the period in the late 1970s and early 1980s, the last time that we saw inflation at levels similar to what we've seen in the fourth quarter of 2021 and the first month of 2022. At that time, Paul Volcker was the chairman of the Federal Reserve Bank. He saw inflation of 13 and 14%, totally a different scale from the 5 or 6% we're seeing now. And he determined that the way to cure inflation was to engineer a recession. He did that by driving interest rates to unprecedented levels. And some of you may remember that the prime rate was over 20% in the early months of 1980. He did cause a recession. Unemployment shot up to over 11% in the United States, but he also solved the inflation problem from say 1982 to now. He engineered a 40-year fix, but he also taught the market a very important lesson, which is that if the Fed overshoots, it will cause a recession, it will affect growth, and it will affect the stock market. So what we saw in January was a general retreat from risky growth-oriented stocks, and in particularly the technology stocks, which had driven the US market in 2021. People feared that tighter money would make it harder for those companies to grow, and that's what we saw.
Brad, Len, you have any additional thoughts on that? What's your sense about the Fed and what they might have learned from that to, as they consider tapering asset purchases and making other adjustments to interest rates?
Let me very, very briefly, and I couldn't agree with David more. I'm going to speak to the right-hand part of our spectrum just briefly. We had a president named Ford, and they remembered that, from Michigan, who gave his famous line of whip inflation now, and you're all given a win button. The institution I was with at the time had Volcker in and a couple of others who really said, look, if you put the brakes on too fast, you're causing all kinds of problems. I agree with David's sentiment. I think the Fed learned a lesson that things need to be done in increments. I would also suggest that wage price inflation for those labor intensive industries are now seeing an increase to $15 an hour. We were talking to, I'm down here in Florida, talked to one restaurateur who said that his brother owned a restaurant in another part of the country. All of his waiters are now going to work for Amazon at $15 an hour, which is his was $5.65. So I think we're going to see some of that reorganization going along. But I think David's point is great. The Fed, I think, has learned a lesson, and how they engineer it, I think, is going to be very key in the short term. And I've been in the advisory business again. I tell all my clients, load up as much cash as you can, because these rates look very, very attractive. I think will look more attractive as we get further into 22. That is, if I'm borrowing money.
Thanks, Len. Brad, anything else?
No, I agree with the
Okay.
comments that have been made before.
Thank you. Okay, Brad, next question for you. What does the pullback in stocks of technology and high flyer companies mean?
So a lot of this was covered by David's last statement. And, you know, when you think about it, the companies that really were not impacted or actually thrived because of the shutdowns were a lot of the high flying tech companies. They did incredibly well as people were forced to work from home, had to buy work systems and really focused on online delivery of goods and services. One of the things I think the markets are expecting is that these tech companies right now or have been priced to perfection. And any interruption in that growth, and we saw this recently with Netflix where they missed their earnings announcement and provided some negative guidance, and the stock sold off by 25%. So these types of companies out there, if there's any interruption in the perfect story that's out there, you're going to continue to see more volatility, specifically within that sector. One thing I want to draw everybody's attention to is that the RPB portfolios represent diversified baskets of investments. And as a result, there's not a specific sector allocation to technology. You all also make heavy usage of active management, and the expectation is the active managers that we've retained will have the ability to tilt the portfolio towards companies that are expected to do well over the future. Again, no guarantee they will be able to do that, but at the end of the day, that's why we have active managers in the program. So I think it's important to realize that because of the higher risk of inflation, it does make the cost of money a little bit higher. We are expecting more volatility across markets, but it's even more important that you make sure you understand that these portfolios are diversified and the importance of staying invested throughout the cycle.
Thanks, Brad. David, Len, anything?
I'm good.
No, I think I said what I needed to.
Okay, thanks. Okay, David, back to you. How will China's increasingly authoritarian tone impact emerging markets?
China's the largest portion of the emerging market, and it's also going to be soon probably the largest economy in the world. a lot of people have become invested in Chinese stocks, and in particular, Chinese technology giants such as Alibaba and Tencent. But I think we learned some very important things in 2021. I like to tell people that they should never forget that China remains a totalitarian, authoritarian, communist dictatorship, in spite of dressing itself up in language as the People's Bank and so forth. It's run by one guy, and if he decides that he wants to take your company, as we learned for those who were investing in the Chinese educational segment, he'll simply nationalize the company or nationalize the industry. If he decides he doesn't like a chief executive officer, it's absolutely not outside of the realm of possibility that he'll take that chief executive officer into custody, in the worst case, take them out behind the building and shoot them, and do whatever they want with the company. So when we invest in China, we have to realize that the normal rules don't apply. Transparency, recourse to the courts where companies are unfair, or where the regulatory authorities treat them unfairly, these don't apply in China. So when we invest in emerging markets, we want to be sure we're not overexposed to China. And I can tell you that your investment committee of the RPB has been diligent in this regard and has an ongoing dialogue with our managers to ensure that we're not overexposed to China. There's a number of risks in the emerging markets, as you're all aware. There could be a shooting war on the border between Russia and Ukraine any day. Iran continues to pose a threat due to its hegemonic aspirations in the Middle East. Taiwan continues to be under threat from China. South Korea continues to be under threat from North Korea. Those are not new stories. They wax and wane in terms of seriousness. So again, emerging markets is an important diversifier for your portfolios. Certainly stocks in many of these markets are inexpensive and provide a wonderful opportunity, but one can't get carried away.
Thank you, David. Brad or Len, anything to add?
I think David's done a very, very solid job. I want to just reemphasize one point. This is looked at by the investment committee and Brad's firm on a very regular basis. And without saying anything more than that, we're trying to stay on top of it.
Thank you. Okay, next question to Brad. What does the highest inflation in 30 years imply for interest rates and market returns?
So it's not surprising, given all of the fiscal and monetary stimulus that's been injected into markets globally, that inflation has started to spike. And a lot of economists out there have been looking at this, and they believe that while inflation is running higher than a lot of people thought it would, that over the longer term, over the next 5 to 10 years, as an example, that there are a lot of factors out there that people need to be aware of that could be a headwind to higher inflation. And those types of things relate to continued innovation in technology, as well as demographics. You know, an aging population, which a lot of countries have, is deflationary, as people, when they do retire, end up buying less goods and services. As a result, at our firm right now, while we acknowledge that inflation is going to be running a little bit higher than expected over the short term, over the next year to 3 years, we believe over the longer term, inflation is not going to be as big of a risk. But again, this is something that nobody knows, and it's something that could change pretty quickly, and it's something that everybody does continue to monitor out there. As you look to your portfolios, for long-term investors, equities have actually historically been a really good hedge against inflation over the long term. The challenge is people that have a shorter investment horizon. Inflation has really difficult for people that are on a fixed income and don't have a lot of longer term income coming in. With that, it's important to recognize that the RPB portfolios do contain inflation hedging assets in them. And it's something that as you allocate more and more money to fixed income and go more conservative with the RPB portfolios, the larger the allocation is to inflation sensitive assets, specifically TIPS. So it's something that's built into the structure of the portfolios, and it's something to be aware of, but we don't believe that investors in the RPB portfolios need to be taking any action directly as a result of expected inflation. That being said, we do want to acknowledge that if inflation does break through, it is something we need to continue to monitor.
Thank you, Brad. David, Len, anything to add about inflation?
I guess I would say two things in addition to what Brad had to say. I believe, and my firm believes, that a lot of the inflationary pressure is in fact short-term and transitory and results directly from the effects of screwing up long supply chains that occurred during COVID. And when you look at the number of people who became unemployed or left their jobs early in COVID, you can understand the potential to really mess things up. As that gets redressed, we think that goods that are currently in scarce supply will become more available. The second thing is that from a practical point of view for our participants, I think during inflationary periods, our single riskiest asset are long bonds. The longer a bond has until maturity, the more sensitive it is to interest rates. And if interest rates are going up, the price of long bonds goes down. So those of us who have traditionally thought of fixed income as being a safe haven have to rethink that, at least in the short run, while inflation is front of mind for everybody.
Right, David, maybe you want to just add a little bit to that in the sense of what our bond investments are in, because I don't know that we necessarily in our portfolios differentiate between long bonds, medium-term bonds, and short-term bonds.
Well,
right?
For those in tier 2, there is a short bond and a TIPS alternative, which I think is more attractive than the index right now for those who want to avoid the risk of high inflation and rapidly rising rates. In our managed funds, of course, as one moves towards equities, one has a lower bond concentration. But as Brad points out, we've taken steps to include assets that benefit from inflation. So my remark really, Michael, is addressed to those who might be overloaded on medium and longer bonds as a result of tier 2 choices.
Okay, thank you. Anything, Brad? Good. All right. So we're going to recap now. David's going to recap where we are with the economy, and then we'll transition into our Q&A session after just one more slide.
So I think that the economy is in pretty good shape in North America, all things considered. One has to applaud the actions taken by the federal government in terms of supplying ample resources to cushion the blow of COVID, particularly for unemployed workers. And that was supplemented by the record easy money facilitated by the Federal Reserve Bank. As I said at the outset about 20 minutes ago, the risks are that the Federal Reserve will overshoot in rising interest rates and choke off growth. And certainly we will see the federal government become a smaller spender, particularly, I suppose, if the Republicans take control of Congress in the next midterm elections. So the economy is pretty good, but the economy and the stock market are not always the same thing. As Brad is, I think, going to talk about, expectations for the stock market are muted for 2021 or 2022, simply because people have made so much money in the 3 years that have preceded it. So I think for all of our participants, don't expect to see double-digit returns in 2022, almost regardless of what asset classes you pick. I think it's going to be a tough year to make money. I think the economy will do well, and probably the economy will do better than the markets.
Okay. Final slide for you, David, to wrap things up.
Brad.
Oh, sorry, Brad.
So here, I think it's just really important to understand how you're invested. If you're in the tier 1 portfolios, recognize that the way the portfolios have been constructed is from most aggressive to least aggressive. And when you look at the different portfolios, the focused growth is 95% stocks. The moderate growth drops by 20 percentage points in stocks to 75%. And that continues down to focused growth. So each step down is reducing your exposure to stocks or equity by about 20%. You need to stay focused on your risk tolerance. Now's a really good time to review your portfolio. Fidelity has some really good online tools that can give you guidance and help you determine and define what your risk tolerance is. And I think it's really important to make sure you do have a rebalancing mechanism in place, because what that does is it keeps you on target with the appropriate risk allocation.
Thank you, Brad, and thank you, David and Len, for what I hope folks would agree was an interesting session. We're now going to turn to questions, and hopefully we have good answers for everyone. And with that, I will we'll start with Len to ask the first question that came in advance.
Sure. I think a lot of these have been answered, which is fortunate. But let me try and pick one out here. Real estate is part of a balanced portfolio. Given the increase in interest rates and outlook, would real estate still maintain as a worthwhile investment in our portfolios?
Let me take a shot at that one, Len. As I indicated when we were looking at the diversification quote, real estate had a fabulous year in 2021. And any of you who, like me, have kids who are looking for houses know that the price of residential real estate has skyrocketed in almost all markets. The same is true of commercial and industrial real estate. I can tell you that institutional investors are spending money on apartment buildings and commercial properties, office buildings and industrial properties in an attempt to get a long-term return of 4%. That's their goal for a 25-year return. The reason that's attractive for them is because 20-year bonds pay only 2.5%. If we, in fact, have persistent inflation, those 4% returns are going to look very anemic. And the result of that is that the price of real estate will fall, and in some cases fall sharply. So I think real estate is in a bit of a classic bubble right now. And I think inflation has the possibility of popping that bubble.
Thank you, David.
Why don't you take the next one?
Sure. We've had a couple of questions, actually a few questions come in from retirees asking about how they should think about their RPB portfolio in the current market environment. So for example, one person asked, should I, as a 74-year-old retiree who has been in the balanced fund, remain there in the current market? Another person asked, where is it? If a recession takes place, which RPB fund would be safest to put our money in, especially for those of us withdrawing from the fund each month who are retired. And so
let me add to that, because I've got one about after 80, what's the best direction for investment? So you get to speak to the entire spectrum.
Right. So David, why not, maybe without giving advice, because we can't give advice, maybe you want to address how should folks think about their portfolio as they get older, as they transition from working to not working, and as also recognizing that, thank goodness we're all living a lot longer than we used to 20, 30 years ago.
The traditional advice, Michael, and I think most of our participants are aware of this, is that as one ages, one should de-risk the portfolio, which generally means a lower concentration on equities and a higher concentration on fixed income. 2022 is going to be a peculiar year because, as we, Brad and I and Len, have taken pains to note, the fixed income environment is particularly challenging in 2022 because of rising interest rates. So in my business, I counsel a lot of older clients, including some in their 80s and 90s, and in one case, somebody over 100. And we're largely keeping their asset allocation unchanged in 2022, simply because we think there's going to be a flattening of returns across all categories, that equities will be less rewarding, that shorter term bonds might do somewhat better, and therefore might even boost the returns of something like a balanced fund. So in the particular circumstances of 2022, I certainly wouldn't be fleeing equities, but I would temper my expectations in regard to return.
So what I'm hearing, David, is that don't necessarily overreact about what happens in 2022, and in many cases, staying the course might be the right course of action. I'll also add that really, because we could talk about the specific funds and what they're designed to do, but as always, and we've said this before, if you don't have a financial advisor, please feel free to contact one of the retirement planners at Fidelity. They can give investment advice. They can help you think about your specific situation. You could have two 80-year-olds who are retired with very different tolerances for risk. They may have very different other assets that are outside the RPB plan that may lead to a very different decision on how one might allocate their RPB investments. So I'll always encourage you to seek additional advice based on your specific situation. Len, you want to take the next one?
Yeah, here's one a little specific. Talk about how the JBI fund is doing. I think you saw on a previous chart, just on a percentage basis, it was the best portfolio we had. However, we should please reinforce the idea. That's because we were tech heavy in an area that did very well. I mean, I kid with our investment committee, said you can't beat Hashem, but there you go. I think what's important is that we are going to have, within the next 3 weeks, a review by the investment committee of the JBI, to sit there and adjust our weightings to see which ones do we want to maintain, et cetera. So through January, we did better than I had thought. We don't have all of those numbers. I just got a flash report. But remember, we weight different areas of the market against a long list of criteria managed by a firm who has the expertise in doing that. We will find out soon if there's going to be any change. But right now, it's doing what we had hoped, and frankly, better than we had expected. I don't know if that clears it up at all, but we will be examining the JBI fund within the next few weeks.
Great, thank you, Len. We touched upon this a little bit, but there were a couple of questions about our two newer funds. This individual writes, I need to reallocate from a heavier weighting in the growth and income fund and don't necessarily need it to be as conservative as the focused income fund. Thanks. And then another person asked, what's the difference between the moderate growth and the growth and income? And Brad, you want to, I know you touched upon it, but maybe you want to reemphasize about those?
Yeah, no, happy to do that. So the growth and income fund has, been around for a while, and that's the fund that has the most assets in it. And that currently has an asset allocation of 55% in equities and 45% in fixed income. If you wanted to get a little bit more aggressive than that, the moderate growth fund would have 75% equities and 25% fixed income. So 20 percentage points more in equity than the growth and income fund. The equity allocations for all of these portfolios are designed to be similar across the board. So they're all globally balanced, and it's the same proportion as in each portfolio. So going down the spectrum from the growth and income would be the moderate income, which would only have 35% of the portfolio in equity investments, and it would have 65% in fixed income. And I think I saw another question, what's the most conservative? The most conservative fund out there is the income focused fund. That fund still has 15% in equities and 85% in fixed income. If you wanted a higher level than that, you always have the ability to go into tier 2.
Thank you, Brad. Another question that came in, and it talks about, well, the specific question is about if a recession takes place in 2022, which fund would be the safest to put your money in if you're retired? David or Brad or Len, maybe you want to address the question from what do you think about your expectations about whether we would be in a recession or enter into a recession? And if so, historically, what does that mean for the capital markets?
So recessions come on a fairly regular basis. We haven't had a lot of them since the great financial crisis of 2008, 2009, thankfully, but some would probably say we're overdue. There's all kinds of debate going on among people who worry about macroeconomic policy and something called modern monetary theory. And we're a little bit in uncharted territory because of the size of the federal deficit and the accumulated federal debt. During a recession, typically stocks go down, and typically bonds are seen as a safe haven for North American investors. Frequently, we see them flee overseas arrangements because they feel the American dollar will go up against other currencies, and that certainly has been the case in the past. So we're not in the inflation forecasting business. I think that's a pretty tough business, and the joke is that economists have forecast 10 of the last 3 recessions. We're not very good at it. So I don't think anybody should be doing wholesale adjustments of their portfolios in expectation of a recession.
Thank you, David.
Let me just add, Michael, that
Sure.
recessions are almost always felt before their numbers predict them. They generally, numbers are good at telling you where you are, not where you're going to be with any high degree of certainty. But in the past, those asset-heavy types of industries do poorly when things are recessionary. But what I would also suggest is that when you have to take a look at a bond portfolio, it's the duration or the length of the bond that you're really looking at. If it's 3 years or less, typically rising interest rates and recessions have minimal effect, comparatively speaking, than those, as David and Brad have talked about, as long bonds. So you want to be in a portfolio that has the shortest duration of bonds, but also many look for, as we have done in a lot of our portfolio work here at the RPB, there's some very high dividend paying companies with strong cash reserves, sort of a return to basics. For those of us who were raised in fundamentals, this is a very key point. So there's good quality companies out there that are in our portfolios that will still be able to pay strong dividends, strong cash flow to get through current cycles. And those are the ones you want to look at. And I think we've tried to do that. Brad, I don't know if you have any specific examples of that, but I know you've done a good job at looking at some of our balanced growth. In fact, one of the questions was, if you take a look at our income focused fund, the yield in the past, I think, has been just over 4 and some %, which is greater than most people are looking at. But and the balance there between good solid dividend payers and bonds, Brad, maybe you could address that.
Yeah, I would say the key here is it's let me just come back to the question. I don't have the numbers about the yields in front of me,
Sorry.
but no, that's quite all right. But I think everything keeps coming back to your investment horizon. And I think one thing everybody needs to understand, whether you're 30 years old or 80 years old, if you're not going to spend the money within the next 5 to 10 years, you have a long-term investment horizon. And there are a lot of studies out there that show that if you're a investor that is doing buy and hold, if you miss the 10 or 20 best days out there, your total return drops by at least a third. So if you can't pick out the best or the worst days, the danger is you're going to miss the best days. And one of the things we've seen with recessions is that the markets recover very quickly, earlier than expected. They're kind of a leading indicator, which is why we want participants, if you've got a long-term investment horizon, to stay invested and just let the professional managers manage the portfolio. It will ebb and flow. If you're younger and the stock market goes down, it's actually a good thing because you're buying more shares. If you're older, you just need to make sure you can weather the storm. You still have the investment horizon in front of you. But as David said, the closer you get to needing to spend the money, the less equities you should have, all things being equal. And again, there's a lot of caveats to that, which is why we want you to reach out to Fidelity. They can really guide you through that.
Thank you. All right, we have just a few more minutes, and we have a bunch more questions. Couple of real quick ones. I'll address. Is there a transcription available for the webinar, and is the webinar being recorded and will be made available? So yes, the webinar is being recorded. We will email everyone who registered a link once it's available, and we will also post it on our website. As far as transcription, we will look into that, and if we do have or can get a transcription of this, we will also put that up and make it available. Okay, next question. Let me just see here. Okay, so it's simple questions. How do you think about the precariousness of democracy will affect the economy? Anybody care to try that one on? Easy stuff, light stuff.
I'll pass.
Not my country, I'll pass.
Well, who am I to go against the trend?
Well, I mean, look, I think
Look, there's no question. And I think along this line, maybe not exactly. Beginning in about 90 days or less, we're going to hit what I think is going to be called the silly season 1 as we begin to approach the elections. You're going to get a lot of things impacting the headlines. I think the market's not immune from headline risk, and I think we have to be aware of it. Frankly, look, I'm at that age where this year, both dates of my age will change when I hit 80 years old. And that's not too far down the road here. What gets to me is that, will we still have control over the economy as far as related to our investments? The answer is there are going to be some things that will not be changed. I can't predict it. Look, where I hope and what I think will happen are two different things. And frankly, I just don't know at this point. In Florida, where I am, it looks like there's going to be a change in government. And I haven't done any work on it. And I don't know if anybody else has either.
Thanks, Len. All right, just in our last minute or so, I'm just trying to see. There's a question about China. Given what has been said about China, why would we invest in it at all?
So China represents about 35% of the emerging market. It also is probably about 4 to 5% of the global market itself. So it is so big, but it's also growing faster than just about any other market out there in terms of percentages of GDP. So there are really interesting opportunities in China, and it's too big to ignore, but you have to go in with eyes wide open. We spent a lot of time talking to your managers to understand how they're positioning their portfolio. And essentially what they're doing is they're trying to identify companies in China that will not be the target of their regulatory reset and can participate in the growth that's over there. But again, the last time we looked at this, about 4%, 3 to 4% of the RPB portfolios were in China, so very small amount.
Thank you, Brad.
Of the equity portfolio, not the total portfolio, just the equity portfolio.
Right. Thank you, Brad. So we're just about out of time here, and I do want to respect everyone's time. Let me just wrap things. First of all, thank David and Brad and Len for their participation, and of course, everyone for listening in today. Just a couple of quick announcements. You may have heard, but we're expanding eligibility coming this spring. URJ congregations will be able to enroll any employee who works 18 hours or more at a week at a URJ congregation, in the RPB, sorry. And we're very excited about that. We're working really hard to make sure it goes smoothly. So if you're out there and working for a URJ congregation, let leadership know. And we're going to be having a lot more information coming out in the coming weeks and months. And that's really the biggest news we have. And then, of course, our annual retirement seminar, which we are really hopeful and optimistic that it will be in person after 2 years online, from November 6th to 8th in Miami. Not a bad place to be in the late fall. So hopefully those that are thinking about retirement, getting up there, we actually promote it to anyone who's 50 years or older, because it's believe it or not, it's time to start thinking about it. But more information will be coming shortly about that. So again, thanks everybody, and have a great rest of your day. Take care.
Thank you.
Bye-bye.